Welcome to the deep dive. We're here to really get into the important details behind the corporate reports you hear about.
And today we're looking at Eternal Ltd. You probably still know them as Zomato.
That's right. We're tackling their Q2 results for fiscal year 26. That's the quarter ending September 30th, 2025.
And this is a really important one to unpack. Eternal isn't just, a food delivery company anymore. It's complex, multiple parts.
And it's changing fast, especially with quick commerce. Huge operational shifts happening.
Absolutely. So our mission today, break down those big consolidated numbers, figure out what's happening in each segment, food delivery, quick commerce, hyperpure, going out.
And look at the big strategic calls, like shifting away from a key metric they've used for years.
Exactly, because you see these headlines, right? Consolidated adjusted revenue, up a massive 172% year over year. INR 13,968 crore.
Yeah, sounds incredible, like a world-beating growth.
But hold on, that number needs context. It's not really a like-for-like comparison at all. We need to get behind that figure.
Okay, let's do it. So that big picture, 172% revenue growth year on year, 85% quarter on quarter. But then consolidated adjusted EBITDA, that actually fell 32% compared to last year.
Although it did climb 30% from the previous quarter, landing at INR 224 crore.
Right, so exploding revenue, but profitability compared to last year went down. How does that work?
Well, it comes down to why that year-on-year comparison is so skewed. It's almost entirely because of quick commerce. Blinkit.
Okay.
They've shifted to owning the inventory themselves, the 1P model, they call it, inventory ownership.
Right, so previously they were like an agent, connecting stores and customers, taking a commission.
Exactly. Think of it like a travel agent booking a flight. They record their fee, not the entire price of the ticket.
Okay.
But now, Blinkit is acting more like a retailer. They buy the goods, they own the goods, they sell the goods. And under the accounting standards, in AS, this means the full value of everything they sell gets counted as revenue.
So every single item sold through Blinkit, the price the customer pays, that's now Eternal's revenue.
Yeah.
Even though they had to buy it first.
That's it. So the revenue line looks enormous. But of course, the cost of buying all those goods also hits their expenses, which explains why the adjusted profit looks, well, less impressive on a year-over-year basis.
Makes sense. So that 172% isn't really showing underlying business growth in the same way.
Precisely. And management knows this. That's why they also calculate what they call like-for-like, or LFL-adjusted revenue growth.
How do they figure that out?
They basically back out the cost of goods sold in quick commerce and also some non-restaurant revenue from hyperpure that shifted.
And what did that number show?
That shows underlying growth of 65% year over year, still very strong, and 22% quarter over quarter. That's a much truer picture of the operational momentum.
Okay, 65% is still really good growth. That distinction is key. And speaking of metrics changing, this move away from GOV, gross order value.
Yeah, this is a big deal. They're permanently shifting to net order value, NOV, as their main growth metric.
Why ditch GOV? It's been the standard for ages in this sector.
Well, management is saying GOV is becoming misleading. NOV is just GOV minus discounts, right?
Right. What the customer actually pays after promotions.
And the gap between GOV and NOV is widening, quite rapidly, actually.
You could see that just in food delivery, can't you? GOV grew 18% year on year, but NOV only grew 14%.
Exactly. That 4 percentage point difference, that's discounts. Increased promotional spending over the year. It shows the competitive heat.
So reporting only GOV would paint a rosier picture than the cash actually coming in.
Pretty much. Discounts are up, especially in quick commerce for things other than groceries, things funded by Eternal or by brands wanting to push products.
So by focusing on NOV, they're forcing everyone, investors, us, to look at the actual net revenue generated per order, what people are really willing to pay.
It's a move towards transparency, you could argue. Even if it makes the headline growth numbers look a bit less dramatic, a truer measure of sustainable demand.
Okay, that sets the stage. Let's pivot to quick commerce itself then, Blinkit. Because that story is just, wow, acceleration.
It really is. NOV growth there hit 137% year over year. That's the fastest it's grown in 10 quarters.
10 quarters. And they're expanding the network like crazy, too.
Absolutely. Added 272 net new stores just in Q2, brings the total up to 1,816 stores.
And that shift to owning inventory, the 1P model, is that done?
Almost. They said 80% of NOV in Q2 was already on their own inventory. They expect it to level out around 90% next quarter. So yeah, largely complete.
Now, I remember thinking that finishing this 1P shift would give margins a nice bump. Better control, more efficiency.
You'd expect that, wouldn't you? But the adjusted EBITDA margin only improved a little bit, from negative 1.8% to negative 1.3% quarter on quarter.
So not a big jump back towards profitability yet. Why so slow if the model's more efficient?
Oh, well, this is fascinating. It seems the margin improvement is being deliberately held back.
I'll back. How?
It's a strategic choice. They're consciously choosing market share and growth over immediate margin improvement. Okay. Look at their marketing spend in quick commerce, up nearly 4 times compared to last year, 1.4 times just since the last quarter.
4 times. Okay, they're spending heavily.
And they also mentioned passing on efficiency gains to customers. So lower prices, better deals, keeping that value proposition really sharp in a super competitive space.
Right, the 10-minute delivery wars.
Mm-hmm.
So they're using the efficiency savings not to boost profits immediately, but to fuel growth and fight off rivals.
That seems to be exactly the strategy. Buy growth now, cement dominance, worry about maximizing margin percentage later.
And their store expansion plans underline that too, right? They've upped the targets.
I have. They accelerated the goal, now aiming for 2,100 stores by December 2025. That's up from 2,000 before, and longer term, 3,000 stores by March 2027.
3,000. That's a huge network. They're clearly signaling full speed ahead on winning this quick commerce race.
No question about it. But owning all that inventory, it does have other financial effects, doesn't it? Beyond just the income statement.
You mean the balance sheet, working capital.
Exactly. When you own inventory, you've got cash tied up in stock, sitting in those dark stores.
So what's the impact?
Well, net working capital in quick commerce specifically rose to about 12 days of their annualized NOV. It's a key reason why the whole company's consolidated net working capital is now around INR 2,000 crore.
2,000 crore tied up. That really shows the capital intensity of this 1P model and the rapid expansion.
It does. The good news, perhaps, is that the cost to set up each new store, the capex, is still relatively low, around INR 1 crore per store.
Okay, let's switch to the other big engine, food delivery. The original business, the cash cow funding all this QC ambition. How's that looking?
It seems to have found its footing after a slower patch. NOV grew 14% year over year. They actually said the growth rate seems to have bottomed out.
So stabilizing. And profitability.
Still incredibly strong, actually achieved an all-time high adjusted EBITDA margin, 5.3% of NOV.
Wow, 5.3%.
Yeah, in absolute money terms, that's over INR 500 crore in adjusted EBITDA just from food delivery this quarter. It's a seriously efficient operation now.
Okay, let's dig into that margin a bit. The take rate, what they keep from each order, went up by 75 basis points. That's solid. More ads, platform fees, commissions.
Right.
But the final contribution margin only went up by 50 basis points. So 25 basis points seem to have disappeared. What happened there?
That 25 basis points was deliberately given up. It was a strategic move, a competitive response.
How so?
They lowered the minimum order value for free delivery for their gold members, dropped it from INR 199 all the way down to INR 99.
99 rupees for free delivery. That's quite low. Sounds like they're going after the budget end of the market.
Exactly. It looks like a direct response to those newer, really budget-focused apps popping up, like Tuing and Only.
The ones just doing basic meals at super low prices.
Yeah. So instead of launching a whole separate stripped-down app to fight them, Eternal is using its existing gold program.
Leverage the existing user base.
Right. They're betting that even those smaller INR 99 orders will still make some positive contribution in absolute rupees, even if the percentage margin takes a small hit. Protect the flank without fragmenting their own service.
So it's the mature business being tactical, giving up a tiny bit of percentage margin to keep customers across the board and stop those budget players getting a foothold.
Ties right back into that theme, doesn't it? Sacrifice a little margin now for long-term strength and market share. Very disciplined portfolio management, it seems.
Okay, what about supporting acts? Hyperpure, the B2B supplies business.
That seems to be ticking along nicely now in its main job. The core business supplying restaurants grew a healthy 42% year over year.
And the profitability there. I remember it was losing money.
It still is, slightly, but improving significantly. The adjusted EBITDA margin went from minus 2.2% last quarter to minus 0.9% this quarter. Much better.
Getting close to break even then.
Yeah, they sound pretty confident it'll turn profitable in the next couple of quarters. The core restaurant supply part, anyway.
And there was a huge drop in Hyperpure's non-restaurant revenue, right? Down 94% quarter on quarter.
Yes, but that was totally expected. That was basically supplies, maybe staples or other items that were previously sold externally but are now being funneled into Blinkit for their own 1P inventory needs.
Okay. So just an internal shift. Makes sense. It confirms Hyperpure is really supporting the quick commerce operation now.
Exactly. Structural alignment.
Then there's going out, using
Yeah.
the District brand. That looks like it's still very much in investment mode.
Oh, absolutely. Pure category creation at this point. Burning cash and adjusted EBITDA loss of INR 63 crore this quarter. High investment, high risk, potential high reward down the line.
What are they actually doing with districts?
Two main things highlighted. First, launching district stores. Seems like they're trying to digitize offline retail experiences and deals. They mentioned having about 3,400 outlets onboarded.
So moving beyond just restaurants.
Yeah.
Deals at shops, maybe other local businesses.
Seems like it. Building a platform for offline discovery and deals. And second, they launched District internationally in the UAE, combining dining out offers and live event ticketing.
Interesting. Taking it global already shows ambition.
Definitely signals they see it as a potentially big, scalable platform, hence the heavy investment now.
We also saw something new: board approval for a separate company, the Eternal General Service Foundation. What's that about?
Yeah, it's a wholly owned subsidiary, set up specifically for charitable and social welfare stuff, hunger relief, healthcare, education, that sort of thing.
So a dedicated CSR arm.
Pretty much. Starting small, initial capital of just INR 10 lakh. Financially tiny right now, but it's a formal structure for their ESG activities, important for reputation and, corporate responsibility as they get bigger.
Okay. Before we wrap the financials, there's that lingering issue, the regulatory risk, the GST thing.
Ah, yes, the elephant in the room. It hasn't gone away. Still this ongoing legal question about whether they owe GST on the delivery charges they collect from customers for the delivery partners.
It's complicated. What's the exposure they're reporting now?
Well, they're currently facing demand orders. That's for the period October 2019 to March 2022, totaling INR 420 crore.
420 crore. Okay.
Plus, there are show cause notices for the next financial year, April 2022 to March 2023, for another INR 21 crore. And you have to add potential interest and penalties on top of all that.
Yeah. So it's a potentially large liability hanging over them.
It is. The company states they have strong external advice saying they have a good case. But until it's resolved legally, it remains a significant risk factor, a contingent liability on the books.
Right. Okay. So pulling it all together for Q2 FY26.
Yeah.
The big theme really feels like this massive strategic reshaping, pushing incredibly hard on quick commerce, owning inventory, expanding stores,
While also playing smart defense and food delivery, using pricing tactics to protect market share from those budget players.
Yeah, it feels like a quarter where they really committed to the costs involved in this transformation. A foundational quarter, maybe? Paying the price for future dominance.
I think that captures it well. And it brings us back to something management actually said this quarter, which I think sums it all up perfectly.
Oh, was that?
They said, and I'm quoting roughly here, if we have to choose between high-quality, sustainable growth and a short-term sacrifice of margins, we are in a position to choose the former.
Right. Choose growth over immediate profit bump. Choose getting to 3,000 blanket stores. Choose building district, even if it costs money now.
Exactly. Because they can. That highly profitable food delivery engine is churning out over 500 crore in EBITDA each quarter. That's the fuel for this ambition.
So the provocative thought for you, the listener, is really about that trade-off, isn't it?
It is. How do you view this constant, aggressive balancing act? They're deliberately sacrificing near-term profitability in these growth areas, quick commerce, going out to fund this race for scale and category leadership. Does that make you more or less confident about their long-term financial health and their ultimate goal of becoming this multi-category powerhouse?
That tension between profit today versus dominance tomorrow.
Yeah.
That's the core of the Eternal story right now. Okay, that brings us to the end of this deep dive into Eternal's Q2 FY26 results.